Good to be back after a week off due to my travel schedule. Yeah, we had such a great time over in Australia with our friends. Our Aussie Turtle event, meeting a lot of good people in Australia at the event, and all the activities we had there. My wife is really into animals, and so we met a lot of animals. We had a really good time hiking and snorkeling and visiting. And of course, Richard and his group showed us a really good time. The secret to Richard's going to Australia and visiting with Richard is he has a couple of outstanding friends who we met as well, Simon and Adam, Simone. These people showed us such a great time and really hospitable and treated us to a good conversation and food and beverages, and everything was just fantastic. We were so welcomed and enjoyed all of Australia so much. It was what a great place. Sydney, what a great place Sydney is, and we enjoyed Melbourne and the other areas we went to as well. But wow, what a place. Beautiful, beautiful place. Great place to visit. I'm sure it's a great place to live. The whole country is just amazing, and the people are so nice. It's such a great time. Uh, yeah, I can go on and on about that, but we had fun. I want Richard to talk in a few minutes about our event and plans for the future to bring classic trend following out there more so more people know about it and hear about it um, all around the world. Good morning or good afternoon, Oleg. How are you?
Good afternoon, Jerry. Of course, I'm very happy because I'm here. I was waiting more than always, so I was waiting for 2 weeks, but I'm especially very happy. And this week I was really waiting every day. And yesterday I thought it was Thursday, and I thought it was Friday, and I was thinking, yes. Today will be our spaces or our trend following plus nothing meeting. It's a very happy day, and I understood that it's only Thursday, and I get upset. So I'm also really glad that I have seen news about your event in Australia. I have seen a lot of wonderful photos, and really I was very glad that you had such a trend following event. We need such events. It's very important to all of us, and this wonderful environment, wonderful weather, wonderful nature, wonderful animals. Maybe not animals. Not all animals were wonderful. Maybe crocodiles are not. But I'm very happy that you had such experience, such an event. So I was listening every day, almost every day. I listen something from Jerry's interviews with Jerry, do my notes, and in every conversation, I find something new. It's surprising even for me, but I find something new, and I have published my notes from the one of the recent conversations from the podcast. I don't know, I don't remember the name of the podcast, but I like very much when Jerry said that in every element in my life, whether it's a diet and fitness, trading, politics, economics, I am that kind of person who wants that touchstone that I can always come back to, that philosophical core that makes me sleep well at night. At night. So it's really very great for me to hear to this because I'm also such type of person, and I think that's one of main reasons why I'm a trend follower, why I love trend following so much, because it's it's very big and deep, basic, very deep philosophy. So I'm really impressed by these words of Jerry and that approach, and also that Jerry said that Richard Dennis and Bill Eckhart was teaching the total class something that will. I have found this. Their stated goal was to teach us not things that would just work in the 80s or now, but things that were going to work for our entire career. The philosophically, the principles what makes us successful traders, understanding that things, the principle what makes us successful trader, understanding that things change and evolve. So it's very great. It's very great. It's very great to understand that we, as a classical trend followers, we apply to the basics and main laws, at least of a market, and I think that laws of a nature. And because of this, trend following classical approach is unbeatable. And for me, it's at least for me, it's the best approach in the world in many fields, but not on, in many fields, not only in trading, but also in a lot of fields. Really, if we apply our trading rules to fitness, to diet, to learning how to drive a car or something like that, it will be very, very perfect. So, okay, let's get started. I'm very happy to be here as always.
Oh, great. Thanks for that intro, Oleg. I agree with all that. I really um, thank you for being such a good listener and interested in everything that goes on in the spaces and things that I say. I have to be careful what I say because you have a tendency to repeat it. So I'm sitting here listening to say, whoa, did I really say that? Okay, I guess I did. Richard, how are you?
Hi, Jerry. How are you? Look, I've got a bit of technical issues over here for some reason. There's a massive delay on this recording, so I might, after I have a chat now, I might have to reboot back in. But Jerry, it was so wonderful having you over here. Adam and I loved your time over here at Simon, of course, and we're very proud to introduce you to the Australian audience. They loved you, and yeah, we hope you're definitely going to get over here again. And hopefully we're going to get over and see you guys as well, and you, Jerry, and over to Moritz, and start taking this trend following message around the world with all of you. So really looking forward to it, and yeah, I'm glad you're back with Petey and Banana. I know you probably missed them. It was good to see them on your shoulder again, and maybe you want to tell everyone what happened about the parrot that flew onto your shoulder at Scotland Island.
Yes, exactly. Well, we flew over to Scotland Island from Sydney on an amazing seaplane, thanks to Adam, and it was so much fun. It was a short flight, but the pilot took us around a bit and didn't go direct, so we got to see a lot of scenery. I mean, this is just one of the most beautiful places in the world. All of this area that we visited, quite amazing, so much fun. Uh, and then upon landing, we did a little boat ride, and then we went to the house, and I was met by a parrot, which I think had just wandered up and became friends with our group, ironically and uh, accidentally. So we spent the day with the parrot, and the parrot was really sweet, and it made me think of my birds, and I was able to kind of have it sit on my shoulder for a while. I think it made it into our video that'll be out there pretty soon. We had a Moritz's and Adam and Richard and Jerry and Simon podcast, I guess, or discussion about trading and trend. And the parrot made an appearance, I'm pretty sure. And but I think the parrot was a little sick. I'm not sure if the parrot made it. It's still with us, but it was really fun to have the parrot with us for those minutes and hours that we had with it. And one of those things about life, I guess. My birds, they may outlast me, but this is what happens in life. But it was kind of a nice little gesture to see the parrot and remind myself of how much fun I have with my birds. And I did a podcast the very next day. I got my sleep. My sleep is doing pretty well. It's not as perfect yet, but the very next day I had a podcast in the morning, and it was pretty funny. These guys were light and funny, and we were talking about trading and trend and charts. And they were like telling me, we've never had a guest who shows up with birds on their shoulder. And I was like, well, that's weird. Never had a guest with birds. And so the birds would not leave me alone. They really miss me. Yeah, so yeah, I think it's always good to have the birds on. I have been requested a few times. Please do not show up with those birds. Well, I mean that's kind of weird, right? But I have applied to that. I've agreed. And then there's some shows I've been on where I'm afraid to bring the birds. Yeah, I'm afraid to introduce the birds. I want to keep going on, so I'm not sure how the birds would play. Doesn't come across as very serious. If we're going to have a serious discussion here, serious trader. Is this guy serious? Doesn't seem to be very serious when he's messing around with birds a lot. Yeah. So as we wait, just let us know, Rich, when you're ready. Uh, Bruno, how are you doing?
Hi Jerry. Hi everyone. Glad to be here. It's been a time. It's been some time since I missed the last sessions. But I'm glad. I'm here anyway. I was really happy you guys met down under. I was looking on Twitter your photos and the commentary. Pretty nice. I guess it was a wonderful meeting. And I'd like to mention how my systems are performing. Just it's been a tough month, definitely. Um, I guess I got a lot of positions on the financial side, on the wrong side of things. Trends are reverting, and I'm taking a heat from the equity markets. I'm taking a heat from the bond markets, from the interest rates. On the other hand, I'm really glad I have all those positions on the softs. The orange juice is amazing. It's something that I don't know. My life as a trend following trader is pretty recent, but I'm amazed anyway with what orange juice is doing. Cocoa as well, grabbing all new highs. It's not it's not it's not as good as to outweigh the loss from the other sectors, but the softs is definitely what's bringing me. It's making my year. That's it. And it's just another example of what we talk every week here, that for the trend following model to work, you have to have a lot of markets therein. Some of them will be correlated, but not all of them all of the time. And at some time, maybe one of them will make your year.
That's right. Um, Although I don't think, yeah, I mean, I wouldn't just said it exactly the way you said it. I don't really think that trend following needs more markets any more than any other strategy needs more markets. I mean, that's probably not exactly true, but the more popular strategies, stocks have a 8% return or thereabouts, depending upon your start date, I guess, and a 50, whatever, 60% drawdown. So that's totally a function of it's stock only. And if it's just that, it is trend following, it is not embraced wholeheartedly by everyone else. And all of that diversification in currencies, commodities, stocks, and bonds is available. It's just sitting right there for us to use. Easy. Then you throw the shorts in. That's going to make it better. I don't think trend following necessarily is any more dependent. It's going to make things a lot better. Now, trend following stocks is better than buy and hold, as it is with bonds and currencies and commodities. But it so, but it's still going to have a really poor return risk, return drawdown profile if it's just one sector like that. And although I think, yeah, you're probably going to get some more benefit in the stocks by trading those 500 stocks in the S&P 500 individually versus trend following the index. I could not recommend that as a good idea. I did get one question this week. I like to answer these questions. People send me direct messages on Twitter. Why not answer them? Yeah, this is we talk about this a lot, but I can take a few minutes to answer this question. Hello, Jerry. I'd love to listen to your thoughts on trend following. I try to listen in on Fridays whenever possible. One thing I would love to hear your views on is taking partial profits during a trending move. My assumption is that you do not do this. It's one area that I continue to research and wonder about constantly. It definitely can limit portfolio volatility, but how much does it hurt, help your returns over time is the question. Any thoughts, research you have on this would interest me. Congratulations on all your success, and thank you for willingness to share with other traders. Thank you for your time, and have a great Thanksgiving. Well, I think that obviously, it's I think anytime you do a non-system trade, it's going to make less money over time, and I don't have that as part of my system. Taking profits on the way up or before the trend following breakout exit gets hit. And I think it's definitely something that people think about a lot and consider. I really don't have any reason to want to do it based upon the volatility, but I would do it based upon just taking the profit. I think it's just, you recognize that it is discretion. It's probably going to make less money over time. It may really help on a certain trade. You never know. You might get really lucky. And it may be something people need to do to sleep at night. And, as Bruno was saying, these trades dominate your portfolio. That's what they're there for, those big outliers. They're way too volatile. They're much bigger, kind of quote unquote bigger now because of their volatility, and they move your performance around more than you would want them to. They're no longer an equal contributor. They're much more. And so you're like, oh gosh, I wish I could get out of this. I don't advocate discretion, but I would just advocate that people admit that it's just discretion. Even if it's a rule, it has no sample size behind it, really. And but I think on something like that, if you're just going to want to take profits, it's probably better not to do it constantly, to have a bad rule that implements that is a rule that's elected frequently, but once in a while, you really just can't sleep. Since it is not a good rule, just do it infrequently, and hopefully it makes you feel better. But I don't do that. I didn't do that in any of the trades recently. So yeah, hang in there. Oh, I get these other examples. Some of my other friends draw up these crazy examples. What if it gaps open 100% or 200%? Should I get out of some or all or something? I'm like, no, don't get out. Just hang on, and that's what's going to work best over time. Is following the system. But most of the managed future CTAs have, as part of the system, a constant rebalancing. And one of them recently, I tweeted, I got uptight about this one podcast, which I haven't had time to go back, my normal process and read and create tweets about. But he got me all uptight about the politics of this podcast. It was 15 minutes of trading, plenty of arrows and all of that I can talk about, and 45 minutes of stupid politics, really dumb ideas, and which I will probably revisit. And anyways, in this 15 minutes of trading, he did for the first time I'd ever heard, I follow this guy pretty closely, he admitted that vol management was a really fun way of just taking profits. So that's been my contention all along, blah, 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 on risk. It has nothing to do with risk. It's they just want to take profits. And I think that's the way to look at it. You just can't control yourself, take profits. Go ahead, Bruno.
I guess the way to turn it into a systematic trade, this take profit thing, is to perhaps update more frequently your exit or more tightly to the price. But what we get from, or at least what I get from my backtest, is that there's kind of a sweet spot where, okay, take a breakout system. The simplest breakout system of all is you get in at a couple of days breakout and get out and turn your position or inverse your position at the opposite breakout. I mean, you get long on the 100-day high, and when it gets to the 100-day low, you exit your long and make it a short. And the second most simple breakout system is where you get in on the 100-day high and get out on the, for example, 50-day low, where you get neutral, no position, until you get a 100-day low breakout, then you turn short. So what I'm saying is, if you're uncomfortable with that, you can make your exit tighter, not the 50-day, but the 60 or the 70. Or the 40 or the 30. But there is a point where you exit so frequently and wait for so long to get back on the position that it starts making no sense anymore. And for each individual trade, you will feel uncomfortable while you're waiting for your exit to be hit. You're losing money all the while. But what the system says, or what the backtest says, is that system has been performed well most of the time. So you should better wait for your exit until it gets hit.
That's right. And I think the problem with, I like your example. The problem with that example is the backtest shows that those systems don't make as much money as having looser pants. Boom. I mean, that's kind of a bummer. I would always advocate, it's always going to be better from almost every perspective to trade shorter term. But the problem is the computer and the backtest likes the longer term stuff more, given the profit per small loss. So if you're going to risk 50 basis points, how much are you going to make? So with that, in that formula, return versus 50 basis points risk, it always is just prefers those longer term exits. You can hardly be long term enough. You think you're long term enough, and you run another back test, and it says, "Oh, you'll make more money if you're even longer term." So therein is the problem. We all love the 50-day low. It just doesn't work as well because you get chopped around too much and have to get back in at the highs, which is another kind of assumption that everybody gets back into highs, don't you? Well, I mean, I used to think that they did, but I'm not so sure anymore. I'm not sure if everybody gets back in and prevents having a type 2 era by that big trend continuing. I just can't help think about that Eli Lilly, which is like this 600 ATR profit using really loose pants. And it had a 50 ATR drawdown. That's tough, man. I mean, that is tough. That really reminds me of that Tesla trade I did where it made 50 ATRs pretty quickly. 50 ATRs is pretty nice. I mean, it's, it could be it could be my outlier trade. And then it all went to zero if you stayed in because it didn't hit the stop loss. And I think it went to like almost zero profit. And then it ended up making like 500 ATRs or something like that with a big, huge drawdown at the end, but huge monster profit.
Hi guys. Hey Jerry. Hey everyone else. I was just thinking the point that you mentioned is taking profits early. The major issue is the fear of regrets. You see, when something else goes high up, too much. You're making money over money over money on the trade. Then the problem is the fear of regrets. If regret could be, if I would have taken this partial loss, or the partial gain, and because if the trade is going to come down, and if you haven't locked in anything else, there's going to be a fear of regret. Or basically, if you have taken, 70 or 80% or close the trade, and if the trade would have actually continue to be in an outlier mode, so yeah, so you're gonna end up with a regret there. So how how are you gonna manage this fear of regret? And so if you're gonna break the rules of your system, I think the best way to break it is to take 50% of that gain in one go, in my opinion. Because 50% is, because the trade can move either way. So, if you take less than 50%, and you might regret it if it turns down, and if you take more than 50%, you might regret it if it is going to continue. So 50% is a rule of thumb. If you're gonna break it, I say break it right. I hope it makes sense. Thanks a lot.
I like that. I don't agree with breaking it and breaking it right. I don't even know what 50% means. But I mean, take 50% of your profit or take half off, whatever. But, you bring up a really good point. I love that point. Regret, and I think for all traders, it is a lot of regret. And that is exactly what, what you were feeling is this regret. And what needs to occur is this regret it's going to remain, and but it needs to shift to a different kind of regret. And the regret needs to be, I didn't follow the system. I regret not following the system, not regret I didn't make that money. There's nothing to regret. You followed the system. You've done the back test. It's a decent system, but minimally it's decent. It's probably really good. Uh, and I understand that over a long period of time, years, that I won't make more than the system says I will make by my discretion or more uh, overfitted parameters. So um, I'm good with that, and I'm happy with what the back test looks like, and I'd be very happy if I get half to 2/3 of that. And but the kind of regret that you get by not making money that you essentially should not have made anyways, I think is minimal compared to the regret that you would have made more if only you had done exactly what you knew to do. That is bad, bad regret. And I've had that regret. So I know it's bad. And I have it today. I remember, I frequently say this to people. I probably said it in Australia when I met people, because they're always, they're really nice to me. They're bragging on me. They don't even know my track record, probably. It's not, you would think that it was a lot better given all the niceness they were showing me and how they were taking pictures with me and wanting to talk to me and meet me and stuff. But people, they ask me these questions about my history and my past, and I think I may have said it in Australia. I think I say it a lot, and that is, I should have made a lot more, right? I should have done a lot better, not because I should have had better systems. I just should have followed the systems better and more diligently than I did, and stuck with those principles. Because it's amazing how, as Oleg said, you can be taught these principles that are going to be universal for the rest of your life. They're pretty broad. That's how they can be universal. And they're pretty malleable in the sense that the specifics within those principles can certainly have to change over time. But you can still get it wrong because you still violate those broad principles. And yeah, so, but I'll tell you one thing. That was like from day one, Turtle 101 was do the right thing, do the hard thing. You won't get in trouble if you lose money. You'll only get in trouble if you don't follow the rules. And if you don't follow the rules, but you make money more so than everyone else, let's say, in the room, then you're still going to be in trouble. So that's the type of proper mentality and training that you need to talk to yourself about. Um, and you can live with that. You can live. Trading will be tolerable because it's tough and it's mentally tough. But if you're going to judge yourself, it's another advantage that you have with systematic trading, that you can easily judge yourself just on how well you follow the system. And then over time, you'll get better at developing it and hopefully practicing it and doing it as well.
Hi, Jerry. It's Adam here. Can you hear me?
Yes, Adam, how are you?
Hey. I'm well. A little bit tired after a long week of catching up on paperwork and all that boring stuff. But it was amazing to meet you in person, and it's Richard and I are both so glad that you enjoyed your time in Australia, and in particular Sydney. And I think the Bebo's event was fantastic at Double Bay, and it was really good to hear more about your turtle story and get some more of those insider accounts. And I think Michael Caldwell pitched you a few interesting questions on the night, and it was really interesting to hear your response on that. And I know that Simon is really, really busy on putting together the videos, and we're hoping to get that out as a webinar or a video. And geez, I think we got almost an hour of content, so it's going to be really interesting to see what Simon can do there with Richard on the video side. And we're looking forward to releasing that as soon as possible. So thanks for joining us. And as you know, Richard and I are very, very keen to do that again. And, that's in Sydney or New York or Munich or wherever. You just let us know. We're very, very keen to, do those events locally on the ground with you. So thank you so much for coming to Australia and Sydney and joining us. But back to markets. Look, the bonds are rallying, and that can be painful. And I'm looking at some of those charts, and I think the trends are arguably still down in those markets. So there's an element of position sizing there, and I think it's important that people just, stick with their models. If they've done their back testing, correcting, and their position sizing, and chopping and changing in the middle of a trade is not necessarily going to be the best outcome. So, as you say, the biggest regret is going to be overriding those models and deciding to do something that's not consistent with the back test. Not that is a personal financial advice in any way. I guess a philosophy that we've all got as classical trend followers. And I agree with Bruno. These commodities are, thankfully we've got the cocoa, we've got the OJ, we've got the sugar, and those markets are making a huge difference to 2023. We did an analysis, and without those three markets in the portfolio, it would be, it would be a really, really average year. And so, as classical trend followers, you just got to remember to take those trades, even if they, look tough or don't make sense, from, whatever macro or news flow point of view. It's probably best actually just to turn the news off and ignore it completely. And, sticking to the rules, managing, the risk through position sizing and just following the system, I think is the most important thing. And anyway, I'm going to stop talking. But Jerry, it was amazing to catch up with you. I can't wait to get the videos out. And thank you. And back to you.
Thanks, Adam. Well, Lisa and I had such a great time with you and your wife, and you guys are the secret weapon behind Richard. Such good guys, good friends, smart guys. Had such a great time. Simon, what
Hi
a
guys,
guy!
how are you?
Oh my,
Can I ask you a
what a
question?
guy!
Oh, sorry. Uh, can I ask a question about discretional trades? If you were to to do some trade that outside of the system, meaning a one time trade or something that somebody wants to do because of a home bias, etc. Would you still do it using some position sizing scheme or algorithm and taking into account the volatility of the underlying, or you will just do it full discretionary or won't do it?
I don't know. That's a good question. I'm not sure how I would handle that.
Suppose
Yeah,
that
I don't.
you want you have a home bias, right, and you want to buy a company in your city, etc. It's really outside of every rule that you have, but still it has a drawdown, a volatility, and then there is the expectation. The R, for so to speak, and say, I guess that this could be a 5-to-1, a 2-to-1, or something like that. Would you use those things for mainly position sizing, or you rather go full discretionary?
Yeah, I have some things in mind. I hate to admit this, but I am really into non-alcoholic beer. I'm trying to mix that in with my alcohol consumption and be a little more healthy and not drink so much beer and wine. So my wife and I, we really got into this non-alcoholic. And then there's one company out there that makes a really good beer, non-alcoholic beer. And I wanted to invest in this company. And I did a little bit of research, and I think Dr. Pepper, excuse me, put in 50 million, and I think they were probably only allowed to put in 50 million. It's that good. And the people probably said, yeah, we'll take your 50, but no more. And I don't know if they have any other outside investors, but I was thinking, like, if I was given the opportunity to buy into this, because I really like this beer. So it's totally off the trend following. It's just that I like this beer. And I have done this before. I was into other products before, and I was into these Lara bars when I was 20 years ago when I was losing weight. And I thought, man, these Lara bars are really good. So I bought some Lara bar stock, and then it ended up getting taken over by like Philip Morris or something. So I made like 100% in that. And so I think I just have this mentally outside of my trading. And I really am just thinking, um, if I want to, how much do I want to lose, basically? And when will I get out? So maybe I'm not going to size it based on ATR, and I'm not giving a crap about the breakouts because there's maybe not even data. But I just sort of move that out of my systematic trend and into more of a normal way of thinking. But I certainly am thinking, I'm pretty timid too when it comes to doing trades outside of the system. So I probably wouldn't risk very much, and I'd be really concerned. What could I lose if it goes down 50%? And I have other friends that I've known for many, many years. And when I first met them, they were not only doing things like this and being very eager to find great opportunities in all kinds of investments and fields. And they were heavily involved in trend following and CTAs, but they would borrow money to do it. And I was like, crap. So they would get excited and look for ways to borrow to increase their position. And I would be saying, no, 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 I'm way too conservative. For me, trend following is all about, honestly, I believe this. I don't know if everybody thinks it's true, or, maybe I'm overstating it. But for me, it's all about, like, I had this one question that Simon, I'm going to do an interview with Simon and Richard soon, podcast. And Simon is asking me some really good questions. And one of the questions was, I forgot the exact question, but I remember my answer is going to be something along the lines of, oh, the reason I like to use trend following is because I'm very afraid. I'm very, very concerned about risk and loss, but I don't want to give up the upside. And so I think this is what you get. You get unlimited upside. You get the upside that you want based upon your risk budget, your tolerance for risk and drawdowns. And then you have that stop loss and the proper calculation of trade level and the usage of trade level that Richard and I talk about. And then you're as close as you can be to really having a good opportunity to make good, decent money as much as anyone else, and keep that capital loss risk at a really reasonable level given your leverage and your desired profit, your profit potential. So yeah, I'm always really concerned about losing money, and I find that I can get over some of that fear by placing my investments inside of trend following. And when it's outside of trend following, I have a tendency to look at it differently, but still be incredibly concerned about losing money. And I have missed so many great opportunities over the years because I've just seen the world through trend following and diversification and not kind of really gone for it. On had another side of my brain say, okay, put all these other things on the other side and just be a crazy person and invest and don't really think about it in terms of the trend following. That I have not been able to do.
Thanks. Yeah, I was thinking in the same way. Meaning that it would be a very small bet or allocation, and I was thinking more in terms of very stressful situations in terms of liquidity. But in any case, it would be just something small. But I thought that trying to guess an R multiple of the trade, or trying to at least in very broad terms saying, okay, I think I can lose 50% of this and position size that accordingly would be helpful. Thank you.
Morning, Jerry. Welcome back. I've enjoyed all the accents over the past few weeks and envy your trip. Looking forward to the webinars and the videos. Did you say that Covell was involved in the Australia trip?
Covell was piped in via Zoom technology, and so he was there. I think it was a big addition, a positive addition to our. It was the two Maritzes, myself, and Richard, and Adam talking that night, answering questions. And Richard was our leader and moderator, and Covell piped in and had some really good thoughts and questions about trend following and his career. And he was telling some stories about me. And I didn't remember some of those stories. I told him I did not deny the accuracy of those stories. I did not deny the accuracy. I just didn't remember exactly. But I save all my emails. So he said when I said I didn't remember some of the stories, he says, oh, I have the emails. I'm like, I probably have them too. So I'll probably get to that and look at them to see. But no, it was all good. It was all fun. Yeah. I ended up meeting a lot of nice people, some investors. So it looks like ETFs US ETFs can be purchased by Australians. It's not impossible, I guess. I'm not exactly sure how easy it is, but that was good to see. I met a lot of nice people over there. I did a fun webinar while I was there with Corey and Bob Elliott. That was fun. We had a good chat. So yeah, I was doing a little bit of business and a little bit of travel. My wife is relentless on searching out animals and getting in the water, doing these hikes. I've never really done too many hikes, but we did this one hike that was not that safe. And my tennis shoes came through shining colors. They did really well. I didn't really know how they would do. I wasn't expected to do these hikes, but yeah, we did a lot of stuff out there and saw the penguins and the no crocodiles, penguins and a lot of koalas, Tasmanian devil. Yeah, she's relentless. She's nonstop, just nonstop touring and exploring. And I just had to keep up and walking. We walked and hiked quite a bit. So yeah, all fun. Absolute. What's on your mind?
Hey Jerry, hi everybody. Yeah, I'm glad you had such a great trip in Australia. Uh, I've never been to Australia or New Zealand, and it's on my list. Has been on my list. I just need a strong enough reason to get there. And this event looked very appealing, but it's just the timing for me wasn't optimal. But otherwise, I would have just sat on a plane and just got there, because I'm just looking for a reason to get there and explore the continent and New Zealand. And from what you just said, and with all your raving reviews about how beautiful it is, now it's even more incentive for me to actually organize something and get down there. Um, so I just had before I forget it, because I'm not writing things down. I had a comment on the discretionary discussion that you guys had 10-15 minutes ago. Um, So as you may actually guess, for me, that's an absolute no. I mean, and I've said this probably if you made this comment a few times before. For a systematic quant trader, discretionary interference is I don't know how to describe it. I mean, you go straight to hell basically. You're not the way I describe it, the way I feel about it. It's a major regret. I completely agree with Jerry that the regret of maybe losing something or winning something if you did or did not do something or whatever, those should over time, if you do many of those things, those should wash out over time and should actually hurt you, because if you had some discretionary edge, you would be a discretionary trader. The fact that you are a systematic trader is because you suck as a discretionary trader. And I'm not saying there aren't people who know how to do it, or maybe have some information flows that I don't have or access to whatever. But you become a systematic trader exactly because you realize that just punting around on feelings and on knowledge or whatever, it's just not going to work. It's going to put you in the 95% of speculators and traders that lose money, and it's going to take you out of the 5% that make money. And the only way for us to remain in the 5% of speculators and traders that make money above the growth of stocks and bonds and inflation is because we're systematic. So, knowing this philosophical realization, breaking any breakage out of this rule-based system, systematic trading, should be a humongous regret and an identity crisis. When the moment you do it, it's like you eat something sugary, you eat something like a 200-gram chocolate, it feels great, and then after you eat it, it's like, what did I just do? I'm on low carb, sugar is bad for me. What did I just do? Who am I? And that's how you should feel about a discretionary trade. What did you just do? And who are you? That to me is how, and I may have done a discretionary trade or two, maybe 20 years ago, but I don't remember, and I don't want to remember. I have not done anything discretionary in the last 20 years. If I have felt so compelled to philosophically, logically do something discretionary, which kind of all alarm bells are whistling and say, listen, this makes total sense and you should do it. Everything is telling you that you should do it. Then you should reconsider your system. Why does your intuition as a trader and as a human being with the evolutionary biology, why are all these alarm bells ringing around you that you can't sleep at night and whatever? What's going on? Why is nature instincts and gut instinct telling you to do this? Why? Ask yourself. And then ask yourselves, why have you not addressed this in your system? Why are you trading a system, or why have you built a system that has brought to you such a state where you question everything, whether you should get out or not, or whatever? So along these lines, the way I design a system is to not put me in such positions. And now Jerry will, of course, say, no, there's one way that makes the most money, and then you should trade that regardless of what your feelings or ideas or emotions or gut instincts are telling you. And if it's hard, just don't trade. I somewhat agree with that, but I also agree, and I would recommend to others, listen, even if you're trading a system that by some standards is not making as much per 50 basis points as according to Jerry's standard, but if you're trading something that's making you sleep at night and that minimizes the chances of putting you in a state where you're forced to do a discretionary trade, then over the long run, I think you're still going to be better off. Better off than not trading it, not trading the most optimal system, or trading it with frequent and painful discretionary discussions. So I submit here that trading such a system, even by some standards and not all standards, may be suboptimal or quote unquote worse than trading another system. Trading this system that will minimize your chances of doing discretionary trades or minimize your chances of abandoning it together is still better off. Now, if I made this is kind of an introduction. And by the way, I'm not reading from a script. This is just thoughts coming through my head. My main point that I wanted to say about the discretionary trades, and to kind of connect it with how to combine these discretionary trades with systematic. So this is a in that example of a 50%. Let's say you have a big position, big trade, big profits, and Alp or I don't know who's. I think maybe Alp said, oh, it's a great idea. Listen, if you don't know whether or not, it's probably 50-50. So you don't know, take half off. One half will make you not regret it if it continues. The half that you left, it continues, so you're not regret. And the other half that you took off is not going to make you not regret it if it goes back down and you lose it all. So whatever happens, you're minimizing regret. You're not going to have regret whatever happens. It's 50-50. And that's great. Now, the goal here should be how to make something that's not discretionary. Like how to make something that does not put you in that position. And the simplest thing I can think of is, okay, think about two systems. One is 200 days, 200 in, 100 day out or whatever. And another one is 10 day in, 5 day out. So I'm making extremes here to make a point. So one very long term and one very short term. So if you're trading just these two time frames, these two systems, the short one will probably take you out at those moments where you feel like you should discretionary maybe take half off. So then automatically you will be half off. It will take. By the way, both of them independently should be profitable, and they are profitable, but they're so far away in time frames that they're completely decorrelated. But the short one will act as your devil, discretionary devil. Instead, it's a systematic angel. So the short system will systematically take you out exactly at the moments where your gut instinct is telling you, you know what, maybe I should just take half. But what's the problem here? The problem here is if you do not position size, if you don't adjust to volatility, like in the OJ trade or in Coco trade, after 3 years, the 200-day system is still in, and by now, its position is so big that when the short-term system, the 10-day system enters its position size, it's going to not be half. It's not going to be equal to the position of the other system. It's not going to be half. It's going to be 5% or 3%. So the longer you stay in this winning trade, the smaller the contribution of the short-term system will be to doing its job of getting you out of the discretionary conundrum. So it's not going to contribute the diversification. So the problem here is the amount of diversification of contribution of the two time frames. It's highly dependent on how long you're sitting in the trade. If you're sitting in the trade for 2 years, the long-term one is in 2 years, whereas the short one has been going in and out, in and out, in and out. The short one just trades in and out all the time. But the short one adjusts to volatility as it goes in and out. Even though you don't adjust for volatility, every new entry is going to adjust to the current increased volatility, whereas the long-term one is not going to adjust to the current higher volatility. So because the shorter one system adjusts more to volatility and the long-term one does not, the proportion of contributions in the voting, in the system of your voting, it changes randomly and dramatically without you knowing. So the only way for you to keep constant statistical contribution of 2 timeframes voting into your position and adjusting your position, you have to adjust for volatility. So this is just after this conversation you guys spoke, this is just, maybe I should write these things down. This is another argument for adjusting for volatility, to keep the contribution of all the time frames equal and not allowing the longest term time frame to overpower all the other time frames who have been adjusting to the newer increased volatility, whereas the longest one hasn't. So in the end, after 3 years, let's say the 200-day system is long 3 years. If you have not just a short term, let's say you have 10 or 20 timeframes in there that are all voting. The shorter the timeframes of the system, the smaller its vote is going to be in the complex structure of your strategy. So what do you guys think?
Well, I want also to comment on your other 2 points about discretionary trading. So I don't know if I can remember both of them, but anyways, remind me in a couple minutes when I get finished responding to this this latest point that you made. Okay, so I agree with all of that in the sense that it's factually makes perfect sense to me. Now, okay, you're trying your best. Okay, you're trying your best, and I get it. But no, look, I understand you have these desires, and this is all you're describing, is I have this desire. I want this waiting. I want this, the shorter term system is not having this desirous effect that I want. And I need it to have that. I mean, I get that. Okay. However, it's just, I mean, I want a lot of things. I have a lot of desires that the system and the market and proper backtesting and trading is not going to satisfy. You know, I don't want to have these drawdowns either. But I have a higher calling, and the highest of all the callings is few parameters and treating all these trades the same way, following the system. And if you add this short-term system without, let's say, if I added a shorter term system, and I wouldn't, and I do have, a shorter term and a longer term and some in betweens. But when I add the shorter term system, which is still pretty long term, of course, to the longest of my systems, it's better performance. Okay, it's better performance. It's passively better performance. I'm just going to follow those rules. I'm not going to vol manage. I have a desire for it to be even more advantageous and to meet the needs of the shortcomings on a trade-by-trade basis of the longer-term system. It's just not going to do it. I would have to override what I think is correct and say, because I desire it so much, I am going to vol manage. I'm going to do things that I maybe don't really want to do or agree to do. For me, it would be that in order to have this need met that I have deep inside me, I need system one, the shortest term system, to be more helping out when system, the longest term system really needs it. And okay, I get that desire. I just don't see it as a math thing. It's just, I have this desire, but what I see as a math thing as trading all the systems with as few parameters as possible, understanding that when I trade this shorter term system, the computer says, yes, that's better. Add some more systems to it. But it's not meeting your need on a trade-by-trade basis, or very, very often even. It's just what it is. But if you're going to trade with very few parameters, and you're not going to vol manage and correlation management, and do more fitting to the past data, and you're going to look at return versus losing 50 basis points, and not something like Sharp, which is which I would never do, which I think is irrelevant, then this is all I'm going to be able to give you. So is this enough? It makes things better, but yeah, you're right. On a trade-by-trade, day-by-day basis, it is what it is. And I think that's the way I approach it. You get what you get from these more markets and more systems, and you're still left with bad months and bad drawdowns, but it's a bit better. But if you demand from the markets and from these systems more, yeah, I mean, you've got the tools, you've got the computer, you've got the ability to come up with more parameters and rules and more ways to smooth things out. And so this is where we part company. But yeah, I get it. You must do these things. Yeah, exactly. But you're leaving out the part that because I want it to be this way. Yeah, well, I don't need it to be that way. I wish it was that way, but I'm not going to do other things that I think was going to get me in trouble in the long run and I really don't give a crap about smoothness and stuff and making sure that all these trades and periods are not, are painless and pain-free or less painful. Yeah, it's just the cost of doing that is too high for me.
It always comes to my mind the story of Ulysses while he was traveling on his ship. As a systematic trader, I feel as Ulysses at that moment. In the story, he must pass through or by an island that is known to have sirens, and these sirens sing so beautifully that they attract the sailors to the rocks near the island, and every ship goes down near that island. So what Ulysses do is he order his sailors to put some beeswax on their ears so they won't hear the sirens, but he himself wants to hear their songs, so they tie Ulysses on the mast of the ship so he can listen to the song while his sailors do the job for him of traveling through by the island, through the island. I don't know. Sorry, my English is not so good. So I feel myself as that. So I guess our job as systematic traders is to design the best ship and the best beeswax so that our sailors, our models will travel through the markets and not hear our shouting and our clamor to get near the sirens because their song is so beautiful. And what I get that Absolute is suggesting is that trade different systems so that your own is the equivalent of Ulysses' straps, is the equivalent of your own strapping to the mast, so that you won't force your sailor to do what they should not. But I don't know. Is this at the end we're trying to maximize returns, right? And that's the goal of designing the best ship, the best models. So why would you put in less optimal models or worse models in it? Well, because then you can cope with that best model to perform. You can let it do its work. But then you have two different problems, isn't it? You're trying to solve. The first problem is to design the best ship. The second problem is to guarantee you're going to stay in it. I guess what Jerry says is that he's okay with the ship, whatever it is. He takes solace on being on the best ship. It doesn't really matter that it rocks. It doesn't really matter that it will get really close to the rocks at some time and then get back on. It doesn't really care as long as he's confident that he's on the best ship. But it's not that happens all the time. Perhaps we are not sure we're on the best ship. Perhaps our investors don't know that that ship we're in is the best one. And perhaps that's why vol management comes in. I don't know.
Well, I've got something to say here. I think I'm just going to jump in, and I think that vol control is a very, very dangerous game, because where do we make our money? We make our money from outliers. That's when a market does something crazy, extreme. And that's really where the source of returns is in trend following. And as soon as you start, reducing an allocation to an outlier through vol control, whether it's at the trade level or, probably even worse at the portfolio level, you're effectively, curtailing your exposure to that outlier. So, yeah, do it if it makes you feel better at sleep at night, but I don't think it's necessarily going to make you more money over time. So I think I'd probably land on Jerry's side on this one.
So, first of all, Jerry, these things that I'm suggesting, they're not purely my desires that came out of nowhere and I just desire them for some reason. Everything that I say and that I prefer, every my preference has been done because it's superior and optimal according to certain standards and norms and according to certain mathematics and backtesting that I've done. Nothing that I state here just comes out of me purely as a subjective preference without any objective backing behind it. So my desire to have all timeframes to contribute equally on a vol normalized basis does not come from my weird fetish about normalizing to volatility. It is mathematically provable and in a backtest that in order to have different systems and timeframes to contribute, if they're all profitable on their own, if you want them to contribute the most and to maximize diversification, which will maximize risk-adjusted returns, is you need in some way to control how much they contribute through time and through the process. If because of your system design, you allow certain timeframes to constantly be overweighted against the other timeframes, you have now a suboptimal contribution of risk-adjusted returns to your overall portfolio. If you look at your portfolio as a matrix of timeframes and systems, so timeframes on one axis and systems on another axis, every pixel on that matrix needs to contribute returns to your total portfolio. The best way to maximize the risk-adjusted returns of your total portfolio is to in some way control how much each pixel is contributing to your total portfolio. And if you don't, then you are running a suboptimal system. So when you say you make the most money when you do X, right? You make the most money according to your standard of how much my average trade is making for each 50%, 50 basis points per percent. Fine, it's a good measure. And if that makes you happy, keep that as your standard. And you can keep claiming that this system makes the most money according to this standard. But there are other standards by which risk-adjusted returns are measured. In the end, it will matter who, after 10, 20, 30, 40 years, ends up with the most net wealth. Let's say it's one strategy starts with all the strategies start with 1 million. They all trade 20, 30, 40 years and in different standards, and who makes the most money? That's the question, not how much one trade makes per 50 basis points at risk. So these things that I'm suggesting are superior to the alternatives according to other matrix of superiority, risk-adjusted returns. Now, you don't like Sharp, but we all seem to like returns to drawdowns. Like let's say, forget Sharp, but returns to drawdowns, we kind of all like. We're poo-pooing S&P with 8% return and 60% drawdowns, and that's what makes it inferior. Well, if that makes S&P buy and holds inferior compared to our systems, why don't we compare our systems to annual returns and max drawdowns also to see which one is superior? But no, that's not good. The way to measure our systems is how much a trade makes for 50 basis point risk. So there's inconsistency here.
I don't want to be inconsistent, but right. I mean, I understand all of that, and I think it basically just gets back to, and I wouldn't say I didn't enjoy all of that. I mean, it was way more than I needed, because it basically is just back to a one sentence that we just sort of disagree on, and that is, how to measure what is true risk, and then another thing too is it's not just kind of who ends up with the most amount of money necessarily. It is also because people can end up with the most amount or in the top 10% or whatever, and everyone would kind of agree that they got very lucky. You would agree, I would agree. We could draw up that scenario, for instance, nobody in particular, but we could definitely do that. And you could say, oh, well, yeah, even if they didn't game the Sharpe ratio, or if they didn't game the drawdown or your favorite risk measurement, then they got very lucky. And that luck, and the next person who trades this particular way may not be so lucky. So it's not just who ends up with it, but it's just this argument, and it's just another way of talking about this same issue, which is what's the best way to measure risk. And I don't think for trend following, which I hold, in high esteem, and as it relates to its return possibilities and its risk control with the stop loss, trailing stop, all the different markets and the shorts. I don't think that using volatility and Sharpe are good ways of measuring risk. It doesn't translate into the risk of ruin or the risk of some sort of drawdown or loss of capital. So I like the approach that return per trade versus your loss amount, 50 basis points, 20 basis points, whatever it is. And because I think that can translate, and then your win percentage, because that can translate into real loss of capital. And the drawdown on some of these trades that are magnificently profitable, it's going to be very difficult for anybody to catch up with Mulvaney here anytime soon as far as his profits when he finally gets out of his short bonds and his long sugar and cocoa and whatever else he's in OJ. But he will have probably, he's pissing me off with all this great performance, but he will have this big drawdown, I suppose, or a drawdown, and it will be possibly bigger than everyone else's. And then what's left whenever it occurs will be more profits than anyone else had. So I humbly ask that you acknowledge minimally that possibly that looking at his drawdown, when it does come, would be all based upon this drawdown from these amazingly profitable trades, the same trades that made him have the best performance, even after this drawdown, probably. And that would not be as good a long-term way of looking at his risk based upon this could be what a magnificent drawdown, because it does matter to most people whether your drawdown comes on open trade profit when you're making all kinds of money versus is it I think the problem with these drawdowns is that they're all kind of treated equally, and a 10% drawdown on initial $1 million investment can sometimes be translated into a better drawdown than a Mulvaney type performance where he's made 100% on your $1 million, and now he's had a 50% drawdown, but you're still up $1.5 million, and versus a small 10% drawdown, where now the client has lost 100,000 and now only has 900,000 left. And I think this equivalency of drawdown, without taking into consideration, is it coming from capital or is it coming from fantastically open profits, calls into question for trend followers, how the limitations of using drawdown as this metric. And as I've said many times, all of this fancy PhD-like backtesting that people do, digging into these numbers, trying their best to find the best possible ways to trade, they seem to be totally fine with exclusively using risk measurements that come from a performance table made up by a bunch of accountants. And I'm going to dig deeper than that. And then, on the other points, I wanted to just to say that I think that the point you were trying to make about trading being able to trade a system that may not, Jerry would not say is perfect, but at least you're able to trade it. You can sleep at night, and maybe it's not. Jerry doesn't think it's perfect, but why don't we do it anyways? I am sympathetic to that line of thought. I just think there is a line to cross. There is a line that we would all say, I'm going to draw a line right here, and you've gone too far. Niels likes to make this point that, Jerry, we're following rules. As long as you follow your rules. And this is like, no. I mean, no, you can't agree with that. There are situations where even Niels would say, I've said this to him a million times, even he would say, oh, that's a rule that you just crossed my line. And that's a rule that if you violate it, so you can't take refuge in the fact that you have all of this, not you personally, but someone has all of this over optimization and overfitting, and then say, well, I'm golden because I follow the rules, and it's the rules. No, you can go too far with these rules. So to some degree, I do agree with you, but not blanket acceptance, because some people have rules. I listened to a podcast yesterday. They trade different systems for each individual market. No, that's over the line for me. A little bit of profit taking. You've got this big, huge trade. You want to take a little bit off in a discretionary manner. Sin a little. That's a term that Cliff came up with, which has nothing to do with our discussion. I think that's okay. But the habitual, daily, incorrect rules that violate all kinds of robust and sample size ideas, no, you can cross that line, even with absolute. You got to admit, there is some place that even if I told you I had a certain rule or number of rules, you'd say, oh, you went too far. And that's all I'm saying. You can go too far with this. But I am sympathetic to this whole idea that, just because you have to use vol management and correlation management doesn't mean I'm saying that you shouldn't trade. I'm just saying is that if you some people on Twitter, they are obsessed with ease, comfort, and pleasure, and anything works. Any rule is fine as long as it's a rule and it makes you feel better and allows you to do the system. I'm like, no, you could go too far with that, and so probably pursue another career.
Absolutely, I agree.
And Jerry, there are also some things like, for example, home bias, etc., that will make you, some things will get more attention to you that they should, in a scientific way. And I think that as long as you keep those shots very small, as a friend says, a PlayStation kind of position, you'll be fine. And I think that you should still do most of what you do in a systematic way. But there are some, it's like where you send your kids to college, etc. There are things that they're not the optimal, or where you live, etc. Or, for example, now Argentina is in the papers because a libertarian won, and so everybody's thinking about Argentina, or many guys are thinking about investing in Argentina. That's just because somebody on Bloomberg decided that was, a good story. And we are many times trapped by those things, and you got to manage that. But you still have to do it with very small risk of losing your capital. Absolutely. I got a question for you regarding what you said about long systems and short systems. Do you think that rebalancing is a way of volatility, of managing volatility, given that if you do a calendar rebalance, that will make you equalize the risk of your long and short positions? So at the end, doing a calendar rebalancing would be a way of doing volatility, managing volatility, or resetting that thing?
Well, mathematically speaking, rebalancing every second is optimal, but you have to gauge that against transaction costs and slippage. So you have to find your own sweet spot for your own matrix of timeframes and systems as to how often and at what quant steps. And of course, uh, optimal basically your goal is to go through the world always optimally positioned in all global markets every second, every millisecond, every microsecond, and at every granularity of changes in prices around. So if you can run your model every microsecond and then, whoa, now I have to make this micro share or micro future contract adjustment, and you adjust it and you have zero transaction costs, that's what you should do. Your current portfolio position should reflect the statistics of the world as it is now, not from 3 years ago. That's my view.
How does one do that?
Okay, well, this is ideally speaking. Of course, in the ideal world, time is continuous, but you can't. Even chips work in time increments, and shares and contracts are discretionary. You can't split them in half or whatever. So you have granularity in time and in position, in position sizes, and sizing of your exposure to all markets and all timeframes and all strategies. So all these things have to be discrete, quantized in time and in size. And the sizes of these quants in time and in position size will be hugely dependent on liquidity, on markets themselves, and on transaction costs. So this is a whole book that you can write as to how often and by what increments you should adjust your view on the world and on the universe. So this is not answerable.
Yeah. Oh, yeah. Yeah, because you didn't answer it. But
I'm sorry, I cannot answer it
I'm
in a
joking.
space. Yeah.
I'm joking. Now, it reminds me of a fallacy that when I first heard it, I was like, oh, wait a second. I got to have an answer for this, because someone put this to me once when I first started my first client. They were very traditional, well, kind of traditional thinkers. And they said to me, you should not have a position on that you would not put on today. So come in every day and evaluate your positions. And if you would not do the trade today, would not have put the position on today, you should get out of it. And I was like, oh crap, Rich did not tell me, we did not discuss this. So what is my answer? And it's seemingly true, but totally false. Now it's totally false from a systematic trend point of view. Okay, so which is all I know about. And some people would say, well, you don't really know that much about that either. Okay, true, maybe. But because it's not about that. And what you were saying sounds similar to that in some way, because for trend following, it's not that at all. And I remember someone else saying, not recently, but I remember this person saying, I have a new account, or I'm starting a new fund, and I'm going to put all the positions on mid-trend, OJ, I'm going to put that on today, for instance, or sugar, Eli Lilly, these all are markets in my portfolio, and I'm going to put them on because the system says I should have these positions. And I was like, no, the system does not say you should have these positions. And the trend following system says you should have done these trades when at a time where the entry criteria was satisfied. And in some of those trades would have been 2 years ago. So I understand you, and I do this as well. When we get new money in, we put those positions on. But that's not what the system wanted. It wanted you to have OJ on 2 years ago and have all this built-in profit that you now have. That's what it wanted. And so trend following doesn't look at the markets in that particular way. All you're doing is following these rules that the back test says it happens to make money. And it's not any sort of comment on what is the right thing to do today. It's way beyond the system's pay grade to say what is the right trade, what are the right positions today. Much less, let's trim them off a bit. Let's add a few and subtract a few on a daily basis. Who knows? This is how many angels can fit on the head of a pin. These are unknowables. And it's not part of what trend following is. The opposite of all that. It says you won't ever be able to know all of these things. All I can help you with is if you happen to buy at this breakout and sell at this other breakout, then historically the back test says you will take money out of the market. But it's just a game you're playing. You're at the very point. I met a guy in Australia who was telling me his positions and how he got long. Oh, he got short the dollar, like weeks ago. And I said to him, the day you probably got short the dollar, it was probably when the dollar was hitting all-time recent highs. And I was the most bullish, and trend followers were the most happy with their long dollar position against all these different currencies. And trend following is a total fail about any information about what's proper today and what is going to happen tomorrow. When markets that I'm in close at all-time highs, when OJ closes at an all-time high, the last time they did that, I was so happy, had a little warm feeling in my stomach. But then if it's no less likely to start that day, the day after, starting this inevitable give back we're going to have in OJ. So, all right, you can comment on all that, please.
Jerry, let me ask you a question. A question occurred to me. So let's focus on the OJ trade. Let's say it's on for 2 years or 3 years or whatever, and now you're saying because of rules and regulations, when new capital comes in, you have to just put all the positions that the portfolio has and whatever. But there is a third option, like between putting it all in as current and or waiting for the next signal. So the definition of for the next signal, my question is, let's say it was a 200-day breakout that OJ got in 3 years ago. While this system, the 200-day system, is in for 3 years, there were multiple other 200-day breakouts that would have happened if this system wasn't already in. Or my point is, let's say you have new capital and you say, you know what, I'm not going to put you in the current OJ position. We're going to wait for new signals for the system, right? But because the original system is in OJ, any new 200-day breakout that occurs, entry signal that occurs in OJ, you would miss with new capital, or would you wait for a, let's say, another 200-day breakouts in OJ happens right now when the original position is on from 3 years ago? Would you enter this 200-day breakout as a new trade with new 680, with new ATR, with new everything, with new capital?
No, I would not. I mean, I don't think that's legit. The system bought 2 or 3 years ago. The 200-day high now and the ATR now is somewhat irrelevant. I mean, from an accounting point of view, where you can justify it better by just going ahead and absorbing the new capital and pro rata the positions, because people have every reason to expect that the old investors don't want to be watered down, and the new investors, they understand that they're not going to participate in a small loss in OJ. Their loss is going to be, if it reverses, as part of a larger portfolio, but still, it's going to be fairly large. The people who have massive profits built up, they're going to have a bigger drawdown because that's fine because it's accompanied with mega profit. But it's just an accounting thing and what people expect. And rather than screwing all of that up and making these discretionary calls, I would encourage clients. I would, if I was asked, which I am sometimes, I would say, oh, you're in a period now where there's not now in particular because OJ is overwhelmed by other trades we have on, but there has been periods, let's say at the end of 2021 and 22, where we did in fact have massive open trade profits in a lot of different markets. You just got to tell people, you're if we lose 5 or 10% here, no one, old investors, are not going to blink an eye. It's going to be a bummer for you as your first time investor to all of a sudden you get in and wondering where this risk control is. So you do have the opportunity because we let profits run and we're liberal with the open trade profit drawdowns. That it is kind of a bummer that you're going to have this possible bad experience. So I would advise you to put money in every quarter if you're ultimate split your total commitment to the fund up in quarters and take a year to make this investment to sort of spread it out a little bit. And most people say, no, that's crazy. I can handle it. I'll just throw it all in now. I'm like, oh, okay, but you have to do what's kind of right for everybody and the majority of people. But there is no theoretical reason to wait for the 200-day high or to take comfort that this is another 200-day high. Dude, the 200-day high you're thinking about happened 2 or 3 years ago. And the ATR was that back 2 or 3 years ago, not today. But I do have friends who had as a tactical move and as a reason to remain 100% consistent that would time it in that particular way. They will eventually get in to these what I call adjustment trades, capital adjustment trades at the new high. That's fine too. I think it's really we just throw it on, and I think it's one of those areas where I would lean towards coming up with a way of doing things, a rule, and just being consistent with it, and you'll get your fair share of good and bad results from it.
But yes, to comment on the what 5-10 minutes ago, what you said about what Richard said, and whether that you should not be having a position on that you wouldn't put on today, I am in that camp. And most of the quants that I've worked with, or successful teams and whatever, this has been almost as a given. So this is a completely two different philosophical schools, and we respect it. I respect yours, but mine is, as I said, if I was an alien, came to this planet, knew nothing about Earth, I knew nothing about soybeans or crude oil or whatever. I just knew math, and I knew there are markets and that there's time series that these humans recorded these prices through history, through time, and whatever. And now I'm an alien and I want to expose my capital to this planet, to these prices that are moving on this planet. I would want to, my current size, my current portfolio will be the exact same portfolio as if that alien came for the first time, then knew nothing about the planet, and he would put the exact same positions on that I have today.
Okay, I just wanted to say one thing. Maybe I was just being too cute, but I'm not saying I wouldn't do that. Okay, I would do that too. I already said that. I do that all the time. I put the positions on. However, all I was trying to say was I don't do it for that reason. That's not a valid reason because it's not true. I do it for the accounting reason. It's not true that the system is long. I should put them on because the system says I should have them on. No, yes, kind of, but it's deeper than that. The system told you to put it on 2 years ago. So don't use that because it's not correct. Put them on, yes, but just put them on. It's an accounting reason. But I'm just trying to focus on what is the system saying to you. I wasn't around 2 or 3 years ago. I know. But don't corrupt your thought process in thinking, oh, I'm doing it because the system is long and short. True, it's long or short, these different markets. But the system told you to do it 2 or 3 years ago. but I wasn't here. What should I do? Throw them on. Yeah, I get it, but understand what you're charged with doing, which is it's not the same thing. Hey, it's a new 200-day high. It must be legit. No, it's not legit. You got no choice. You got to put it on, but it's not. You're not following the system. You were unable to follow the system because this new money coming in or this new client coming in wasn't here 2 or 3 years ago. That's all I'm saying. It's a real minor point.
No, I agree, and I agree that because of accounting and the rules and whatever you're doing it. What I'm saying is that I'm doing it for much stronger philosophical reasons than just merely accounting.
So some of this, it might make a difference if you're running an open-ended fund. You have certain constraints. If you're not, a closed-ended fund, or if you're trading your own capital, I think you've got options to do things differently. But it is a fascinating topic. Jerry, I noticed that when you were over for lunch, you were carrying a book, The Fund. Did you have anything or any comments maybe about that book?
Oh, I love this book. It's the new book. It just came out. I could not put it down on my trip. I was just loving reading about Ray Dalio and Bridgewater. Yeah, I thought it was really interesting. I tweeted about it a bit. It's kind of a basket case. The firm is kind of a basket case, and it was really interesting to read all of that. And what turned out to be the FBI director under I think under Trump, Jim Comey, was worked for Bridgewater, and he's featured in the book. Bob Elliott, who I was on the podcast webinar with Corey, he's in the book as well. He worked at Bridgewater. But Comey is interesting because he was head of the FBI, and he worked there, and he's got a pretty funny chapter. Now, he wouldn't think it's funny, but I thought it was kind of funny. And he was my neighbor once. He was my next door neighbor when I lived in Virginia for a short period of time. And anyways, so I kind of knew him, I guess, a little bit. He would not remember me, I'm sure. But yeah, so I think that book is interesting. I tweeted about it. I guess initially I was reading articles before the book came out. The author was quoted and had written some articles about his upcoming book. And I was tweeting those. And one of the concepts I was tweeting was that, well, there was thousands of employees or hundreds and hundreds of employees, and about 5 or 10% of them were actually involved in managing the money. And he was very secretive about it. Never really told people how he did it. Never really showed people their positions. He would go on and on about his prognostication about the future, the economy, the government, the world, inflation, monetary policy, earnings, stocks. But he would never really specifically talk about their positions necessarily. And then people inside the firm were leaking information that it was pretty much just trend following. And it sounded like, I didn't tweet this part, but it sounded like he was suffering from the 10-year problem that the CTAs had as well, that Bridgewater's performance was very poor over an extended period of time. But I guess part of the book is just his amazing ability to bond with people and clients and get these large institutions, pension plans, endowments, and sovereign wealth funds, and even countries and government leaders around the world to trust him and give him money, is just amazingly talented at that. And I would give him credit if he was being very secretive, number one, and with the use of trend following, number two. And I think that's what they were kind of saying. It's just all about trend and his calling in and telling people the trades to do. And the rest of the 90% of the company was doing this silliness with his philosophy, his life's philosophy of, it's all described in the book. So of his philosophy of business and managing people, radical transparency, but it was kind of sad and in some ways very sick way of treating people. It was pretty bad. But anyways, I highly recommend it. It's a fascinating read. There's not much you're going to learn about the markets. There's a couple of mentions of momentum and trend. Yeah, but I don't know if you've read it. If anybody else has read it, please tell us your thoughts.
Can I just respond to Adam? Yes, Adam. Open funds don't have a choice to do what they have to do or allocate to portfolio as capital comes in and out. But even for closed funds or even private family office funds, which is closer to where I am, the ability to have a strategy that reflects your view on the world at the moment as it is, it's very helpful in terms of rebalancing and readjusting your capital between strategies, between funds, and between portfolios. Let's say even you're running your strategy by yourself, your own portfolio, or just a family office with 2 or 3 other families with you, and all of a sudden now you get 2 or 3 million from somewhere. You sold something, a property or stocks or whatever. You have extra 2, 3 million. You can put that money immediately into your strategy, and your strategy can immediately adjust to them without any hiccups, without any thoughts on or processes. Oh, shall I wait for a new breakout? Shall I do this or not? And then you have money in your strategy. This allows you to have much more money in your strategy in terms of liquidity. Your strategy becomes much more liquid. The same way you can easily add few millions to it without a hiccup to the percentage performance of the strategy, you can as easily take out few million if an opportunity appeared or property or something happened that you need to allocate money to other things other than your strategy. So the liquidity of the strategy is tremendously improved by the approach that the portfolio as it is today reflects your view, your statistical view on the world as it is today. So there are multiple benefits to building a strategy with this kind of a requirement as opposed to the other.
But I'm guessing that statistical view is just what, based on standard deviation or the current volatility of that individual futures contract that you're rebalancing. Is that your view?
No, it's based on the statistical performance of the strategy on a percentage basis of capital available, and you can run the back test. And it doesn't mean that if you're not doing the profit, if you're not doing statistical analysis on a per trade basis, that you are doing something that's not robust. It's possible to do a backtest with less parameters, which is more statistically robust, that's not based on a trade sample basis.
Do you ever have statistical reasons to do this? Well, I'm trying to repeat the words you use. So whatever words you use, there's other reasons to do this that conflict with what your positions are based upon your system.
I can you? I don't understand the question, Jerry. Can you repeat? Like rephrase it.
Yeah. So when you were describing this flexibility that you would have to take in this new money, and the decision process would be based upon something, evaluating the current perfect positions to have on. Does that ever conflict with your positions that you already have on that were based upon following your system?
No. Let's say
Right.
I'm trading.
Right.
I'm trading
So
10 million. I'm trading 10 million. I get 2 new million in. I increase everything by 20%. Easy.
Right. So, but you're going through a lot of description, but when you boil it all down, you're just putting the positions on, and that's what I'm saying too. Like, I have no opinion except what the system has already told me to do, and so I'm just going to put those positions on. There is no oh wow, now that I have new money coming in and I'm going to reevaluate all of this. Now I'm going to maybe come up with different positions. I remember back in 84, 85, somewhere around there, Rich got interviewed, and we just thought Rich was like the smartest guy on the planet, and if he's not, then he's number 2 behind Bill. So, and so he gets interviewed. I think it was by Barron's, and they ask him like, "Well, what is your opinion on the rest of the year? Like, what do you think is going to really do well the rest of the year?" And we were like, "Oh wow, let's see what Rich says." And so what he said was he went down his positions, the same positions we had on, and said, I think this is what's going to work. It was like, just repeating our current positions. I was like, oh, yeah, I guess that's what he would say, right? The system, knowing full well that in a week or two, if we were long cocoa, we could be short cocoa. But, if you're going to ask me right now, my best guess is what's going to work well for me in the future is going to be the current positions I have on. And I think that's I thought that was pretty funny, and funny in that I didn't really guess that was going to be his answer. But what other answer could he possibly give? Whereas everyone else would be analyzing the markets and the Fed and the economy and making these bold predictions. We're just going to read from our position sheet.
But Jerry, he could afford to say that because his systems were much shorter term, and he knew that in 2 weeks he can readjust. If he was trading 200-300-day breakouts, he probably wouldn't have made that statement, which is also why with longer term systems, people get more incentives or gut instinct to start doing discretionary stuff and everything. So there is the difference there. And the point that I'm trying to make is that I can easily take capital in and out of my strategy on a daily basis without affecting its statistical edge. In order for you to take capital in and out, significant capital in and out of your strategy, 20-30% in, 20-30% out, or whatever, on a weekly, on a monthly basis, if you do that, too much of that, you will be very wary to be doing too much of it, because you will be wary, and rightfully so, that you will screw up the statistical edge of your strategy. You wouldn't know what to do. You wouldn't know what to do with 30% inflow, then next month 30%. I'm making an exaggeration, of course. No fund has this kind of volatility of inflows, but hypothetically speaking, my approach can handle any volatility of inflow and outflow. Yours can't.
I don't understand. I mean, I just handle it by adjusting the positions. I'm not following what you're saying.
Oh, so you're gonna 30% in, you're gonna put all current positions, then a month later, you're gonna take 30% out if it needs to go out?
Right, if I have these additions and redemptions, right. And it's not going to affect me at all. It's because I'm just adding, I'm adding pro rata, subtracting pro rata. And so my performance table performance is not going to, it's going to have the same performance.
Okay, you're saying, but okay, you would do that because accounting says you must do that. If you're trading your own 50 million, your own fund, for one reason or another, you have 3 or 4 other businesses, they may or may not require capital or create capital. So let's say you are trading 50 million and you have 3 other businesses that now one of them requires 10 million investment or 20 million, or because of one reason or another. You need to make your fund now down to 30 million, right? So now it's million. Then a year later, these other businesses made money. Now you have 40 million. So now from 30, you have 40 million available to put in your strategy. It's going to be 70. What would you do with your own capital if the volatility of outflow and inflow was like this?
Oh, I see now. Yeah, that's a problem. I am personally screwing up my own personal expectation that I'm going to get out of this because I am having these massive. Yes, I agree with that totally. The performance table will look the same, but I would definitely have an issue with. I agree with that now. I agree with exactly what you're saying. You don't want to have these big shifts personally speaking. In a client who does that, who's trying to get in and out of, trying to find the best place to get into the fund, and then now let's get out of the fund and avoid the drawdown. They're really screwing up their edge.
Exactly. So my point is that there are different levels of approaches. Like my approach is liquid in the sense that its statistical edge does not get screwed up by the volatility of inflows and outflows. It makes it more liquid. At any point in time, I have more money instead of just saying, no, this is X amount of capital and I'm not going to add to it, I'm not going to subtract to it, it's just going to sit there. But if it has a statistical edge, why not optimize the allocation you're giving to that strategy with whatever other things you're working in your life? So you have a diversified portfolio of investments in your life. Sometimes other things make money, lose money. Sometimes other things need money. Sometimes other things produce new money that is better redistributed into the strategy. So in order for you to have an optimally balanced allocation of all your investments in all your portfolio, liquid strategy like this, whose statistical edge doesn't get screwed up by frequent inflows and outflows, are superior.
I would say that I don't know how you're doing that, and what characteristics you're ascribing that you don't have this issue. But then another major problem with what you just said is that for me, the other investments, I don't have them back tested. I don't have my real estate investments or my private equity investments back tested, and I don't know what those edges are to the degree that we feel like we have more confidence in being able to measure our edges in trading, trend following, because we have that back test.
I know, but let's say you want to keep your strategy at 30% of your net worth. 70% of your net worth is distributed in other things. Let's say 5-6 other investments which are decorrelated. It could be Tesla stock, it could be Bitcoin, it could be, I don't know, a gas station business. I don't care. And one of them shoots it out of the park, one of the other ones. And now all of a sudden, that becomes 80% of your net worth. You're lucky, you're happy, it's an outlier. Now you're exposed, 80% of your net worth is exposed to Tesla. Tesla exploded. You probably would not feel comfortable keeping 80% of your net worth in Tesla. I don't care how much you like outliers. But at some point, you're going to say, you know what? I have perfectly good other investments. I have a good strategy, which I want to keep at 30% of my net worth. But now my Tesla is 80%. My strategy is now at 55%. How about I take some of the money from Tesla, bring my strategy back to 30% of my net worth, and keep Tesla still, Tesla's going to be whatever. I don't know. Now it's going to be 30%. I want to rebalance. Now my net worth is 30% in Tesla, 30% in my strategy, instead of 80% in Tesla, 5% in my strategy. So as investments perform, outperform, underperform, I'm not saying rebalancing this monthly or even yearly, but in situations like this, if you have an active portfolio, if you have investments and speculations that are constantly dynamic, having a liquid take Tesla and get double. Now, let's say the strategy was 5 million, and now it's going to be 15 million with the extra 10 million coming from Tesla. Statistically speaking, you're better off trading 15 million of your that 10 million putting in your strategy, which has a statistical edge, and taking it some out of from Tesla. So these are the situations. This is just one example. So when you're saying you can't, but to optimize your final net worth, it's good to have strategies and that can handle this volatility of inflows and outflows. I don't know if I was still on. Anybody can comment on this?
Oh, I had a technology problem. Can anybody hear me?
Can hear you. Yeah.
Now I can hear you.
Okay, great. Deboned. Is that what you want us to call you? You requested to speak. What's going on?
What's going on? You were talking about the book with Ray Dalio, and I'm about like 3/4 of the way through it, and yeah, it's an interesting book. I just wanted to. You were laughing about it because obviously it's pretty crazy, some of the points that it was making, but one of the craziest things in the book I really couldn't believe was, and I don't know, maybe you called it, was he videotaped that Jensen guy. He was like begging for his job after he'd like done he had a couple infractions, and he basically videotaped the guy begging for his job, crying, and like gave it to everybody in the office to watch or something like this.
Oh, it was horrible. I mean, all of that stuff. It's just ridiculous. And you watched it and played it back, and I mean, it's just a nightmare. This guy.
So what
I,
do you think that was just for his entertainment?
I think he was playing God, and he wanted and the managing the money was just like I don't even have to think about that so much. And like I said, he was very, very good at getting the clients and selling the clients on his story, um, and that stuff.
Well, let
Regardless,
me ask
regardless
you.
of regardless of performance, but I think that he wanted to be this godlike figure to have people follow his methods of how he wanted to live life, and but it just seemed to be a crazy situation where people were just hundreds of people were being fired, hundreds of people are being hired on a constant basis, and having this ability to torture and torment people with this crazy philosophy of his, and it's really messed up. It really
And
is
there was like
messed.
this scoring system. Like basically, you could see how you. It was just like some big social experiment, and on a daily basis, you were getting reviews about basically your social scoring. You had like a social scorecard, pretty much.
Oh yeah,
They
it's
actually gave you like a baseball card.
yeah.
But I just wanted to ask you, how much of his initial success, which probably led to his overall success, might have been due to his marriage to that his wife. She was a Vanderbilt.
Right, right. Well, I think, like I said, I think I like to separate the performance, which let's say it's probably mostly trend and currencies, commodities, and bonds, as well as stocks, and then his ability to raise money. And it's just the whole person. I think his parents and his initial, he was very aggressive as a young person, getting into business and doing things and failing and then doing something else, and then probably marrying her helped his social standing. Yeah, I think just him as a person and as a tough guy. I mean, he's obviously mentally tough and talented in knowing people like stories, and he used all of that to raise the money and keep the funds going. And I think even like that 10-year period that like CTAs had. I think as I said, I think Bridgewater. It sounded to me like they went through that same period that all trend followers went through. He still went from like 160 billion to 140 or 120 billion. So he was losing clients and getting more clients. He just had this way of transcending performance, and AUM was greater than you know big than just didn't seem to impact him. You know, yeah. But he's just the type of guy who, before I read this book, I just really dismissed him. As kind of, I'm not sure what they're doing there, and it doesn't sound like anything I should be jealous of and want to really dig deep into. I don't know if that's just, and I think I have been frequently wrong in dismissing exotic personalities, eccentric personalities like that. But I guess I don't think there was much behind them. And now he's out, and I think it's being run by other people, and they're trying to keep him out. And so maybe it still has a lot of money under management. I don't really know.
Wait, he's out of the picture now in terms of like managing, or
Well, I mean, into the book, he resigns. He's gone, and I think he's
right?
still.
I haven't got to then.
Oh,
I'm like three-quarters of the way through.
oh sorry, but yeah, I think
That's fine.
he's still out. I think I read something recently before I read the book that he was trying to horn his way back in, but they were keeping him out.
Yeah, I was just kind of surprised. I was hoping for more details about like their trading strategy. I don't know if they talk more about it at the end, but like, it's pretty much nothing. I think there was one mention about they had the motto that markets had a tendency to trend. I think it was literally one sentence in the three-quarters of the book that I've read, but there really wasn't too much info about that. But definitely interesting. It was a very interesting look into the company environment, and everybody likes a crazy story, so it was definitely entertaining.
Okay, I got to get to work. I'm going to let you guys go. enjoy your Friday after Thanksgiving, and have a good weekend. And we'll get back to it next week, next Friday. Hopefully, Richard's technology will be fixed. And yeah, good to be back, and happy trading, everyone. And talk next week.